Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. I was looking at the comment section. I also looked at my PayPal account where people are donating money. And if you're interested in donating, there's a link in the comments description field below. If you want to donate, you don't have to. It's completely up to you. In the donations, someone asked me to cover something, and I'll cover it. They donated to the channel. Of course, I'll cover it. They asked, how would a high oil price impact the mining companies? And one thing I'll go over is the mining companies, they usually do very well at the beginning of these bull markets. It seemed like last bull market, and I'm going to pull up some data here, and this was of the performance in the 1970s bull market. And I just wanted to cover it because it touches on this subject, I think, quite well. So what I have here in the upper left are oil prices. Oil prices in the 1970s to 1981, and we're going down on this one. This was the average oil price. You can see it kind of like lagged for a good amount, and then it really started to take off between 73 and 74. The OPEC oil embargo ended, and it was boom. It was a big price move, and it moved kind of in waves, 74 to 77, 78, and then boom, another huge hit in 79 and 80. It really went vertical at the end of the bull market. You could see it go all the way to the end of 1981. We went from $3 to 37.1 in this bull market. Looking at the right-hand side here, I've got the uranium price during that same time frame in 1970. This is in 1982 dollars, and you can see this big old move. This is the current prices here of a big move up till about 1980. This also really took off, I'd say 73, 74, very similar to the price moves of oil, and peaked roughly at the same time or just slightly before oil did. So these two markets are very much correlated. They are very good inflation hedges. Now looking at the gold price, this is the gold price. And this one goes from the bottom up. That's just how they posted it. Going up, it started at $35. And remember, these are averages throughout the year, not the peaks. And went all the way to $614 by 1980. So we had a very good bull run from 1970 all the way till 1980. Now, and I don't have this up here. I'm just going to describe it though. The Huey to gold ratio, we'll call it the last bull market. This was the 2000. We'll call it the 2000s bull market. The 2000s bull market. It did the mining companies did very well in the beginning of that bull market, but did really bad at the end of it. So they did very well from about 2000 to 2004. The first kind of, I'd say it wasn't the beginning of the beginning was 98, but it did very well from 2000 to 2004. After 2004 till 2011, it underperformed. The mining companies underperformed the metals. So we could see that in the ratio and how the ratio changed, which was the Huey to gold ratio. It's $HUI to gold ratio. And we also saw it in the XAU, dollar XAU to gold ratio. And they peaked out and then they started to fall. That is something that I'm monitoring on the channel. I didn't pull it up for this particular clip. In fact, the XAU to Huey, the Huey to gold ratio and XAU to gold ratio are completely favorable right now. And I suspect that the mining companies could outperform in the beginning of this bull market, just like they did in the beginning of the 2000s bull market. But that's something we're going to monitor on the channel. And it's something that I'll throw into some of our updates. And in fact, I'll pull it up since we do have it. And I've got the account here ready to go. Let's just take a quick peek at it, and I'll show you. Hopefully I have the XAU ratio in here. I don't know if I set it up actually after I think about it. Let me go down here. I think I have it. Fingers crossed. It's not in there. Let me go on up. Hold on. Gold to silver ratio, Dow Jones to gold. Let me move on up. Let me see if I got it up in my things here. And I might not have it set up yet. I don't have it set up yet, but I will set it up for you guys. We'll go over it, and I'll let you know when I think I'm going to be Xing out of my mining companies. I have a good chunk in the mining companies in a mutual fund. So I'm kind of playing it with a lower risk approach. I have two mutual funds. I can share it. They're free for me to enter them in my 401k, and that's the reason I hold these two, because I can go in and out. I don't really trade in and out of them, but EK Wax is one of them, and the other one is OGMYX. Those are the two mutual funds. I'm not stating that these are the best mutual funds, but those are the two that I own if you want to know what I own. And I do own a very good chunk in it. It's in the 6-digit amount in both of those investments. So I do think that we're going to outperform in the beginning of this bull market for some time. I do think we're going to see a pop here in, hopefully we see a pop in gold and silver at some point. I'm a huge bull on it. Obviously, people probably know that. And if we see high oil prices, I do think towards the middle to end of the bull market, that's when oil starts to take off. And that's where I'm going to be positioning out of my gold and silver mining companies and probably going more towards the energy companies. Energy companies have a little bit more leverage than gold and silver do at certain points in the bull market, and they're usually at the end. Like, you get massive leverage. So I think it's a good thing to hold some gold and silver to diversify the portfolio a little bit. And if we have a monetary issue, that's kind of why I own that gold and silver in there. I also like the physical metals, probably the best of anything. The physical metals is a play on increasing energy prices. So when you say, well, what if energy goes to $200 a barrel? It doesn't care about $200. All it's doing is it's pushing the cost curves up of all of these companies. And if we have energy shortages, like a crisis, which we may enter, we'll see, it's going to push the metals even higher. Because metals, a lot of these metals, especially silver, is the number 2 commodity in the world. It's used in all of these different products everywhere. That is value to humans. It's one of the most valuable commodities to humans. I'm not saying price-wise. What I'm saying is its uses in items. And if the cost curves go way up, or we have problems with mining silver on a big, we'll call it global basis, I think that the price will go up, and owning the physical metal is the least risk way to play all this. It also has a monetary aspect to it, which I think is great. So not only is it the number 2 commodity, it's got a monetary kind of icing on the cake with it. And when people get scared, they run towards gold and silver. It's those two that they run towards right off the bat. So I think it has a place in everyone's portfolio, especially even the physical metals. So the way that I'm playing this is mining companies when they're cheap, which we see the XAU, and I'll make sure that I put this in our updates so we can track it. And when that peaks out and starts to rotate differently, I'm going to swap out and go into physical metals and or energy stocks. Energy stocks, I think, will do well the entire time. They are highly leveraged to the price of oil. I think oil got back to what I consider to be the beginning of a bull market move. At $60-something, that's like the beginning of a bull market. It's kind of like at the average price. And then when this inflation gets priced in, I think oil is going a lot higher. I think we're going to have problems over the next couple of years. Some people will disagree with it. Some people will put out articles saying otherwise. Other people will agree with me and put out articles saying that oil is going much higher. It highly depends on the analysts. It highly depends on what you're looking at. But it's the number 1 commodity. It's always gone up in inflationary periods with real estate. And I think that's probably one of the most leveraged plays that you can play in an expansion phase of real estate. So that's why I'm playing it. There's no investment really going into it at this time. When the FOMO kicks in and everybody starts getting all amped up about it, it'll chase. It'll chase and come running in towards the end of the bull market, like all the other retail investors do. So that's my take on it. Again, guys, if you guys like this content, give me a thumbs up. If you want to donate to the channel, and I'm not asking you guys that you have to, it's in the link below. I'm just commenting because I commented on one of the people who donated, and thank you for donating. If you're donating to the channel, thank you. And if you guys haven't subscribed to the channel yet, go ahead and subscribe. Love to have have you on our team riding this bull market higher with us. I'm going to cover this stuff day in, day out, and give you guys the support and the mentorship and the data to hold through this. We're going to have really good times ahead of us, and we're going to hit some snags along the way, just like we are in uranium and oil right now. It's not really a big snag to me, but I know everybody perceives things a little bit different than I do. I kind of know this stuff inside and out, and I'm really comfortable and convinced that this is going to come with these patterns all breaking to the upside. I'm really excited for what's ahead of us. So share the excitement. Let's join the channel. Let's ride this thing higher together. And thank you for listening. I'll catch you next time. Finding value.